Hi, today I'd like to talk about the ABInBev acquisition bid for SABMiller. This is one of the largest deals of the last decade, and as with any large M&A deal, I approached this deal with a lot of skepticism. Skepticism why? Because I know the history of big deals is not a pretty one. In fact, there are lots of deals which have destroyed value so quickly that they've ruined the acquiring company. Now let's set the table. In this deal, the largest beer manufacturer in the world, AB InBev, is trying to acquire SABMiller. Each brings different strengths to the table. AB InBev has a very large stake in Latin America, especially in Brazil, through its InBev acquisition. SABMiller has its largest stake in Africa, followed by Latin America. But in Latin America, it's in all those countries other than Brazil, Colombia, so essentially much of Central and South America. Now, if you look at the potential reasons given for the deal, I see two reasons offered by the acquirer and the bankers and the ecosystem around the deal. The first is this notion of global complementarity, which is true. These companies come in strong in different parts of the world. Now, from a valuation perspective, you're saying, so what? It's not as if you're going to buy a Bud Light because AB InBev now has a bigger Africa operation, but it might allow them to expand into the others markets. In particular, Africa is the fastest growing beer market in the world, and Latin America is the most profitable. In this case, there might be a potential benefit for these two companies from coming together. There's also this talk of consolidation, a word again that fills me with dread because it's often used as a substitute for a real argument. Here again, though, AB InBev's history suggests that they have succeeded with acquisitions. With Grupo Modelo, the Mexican brewer, for instance, they took the company over and they cut costs. Presumably, there are some economies of scale and cost cutting that can be pulled off after the merger. We don't know how much, but those are the two stated reasons. Now, how has the market reacted? It's actually reacted very well to the merger. At the time the deal was announced on September 15th, when no numbers had been thrown around, the market cap of AB InBev was about $175 billion, and the market cap for SABMiller was about $75 billion. You add those two numbers together, the market was estimating a combined value of $250 billion. Now, a month later, once the deal's been actually announced and the numbers are out, the market cap of the combined company has actually gone up to $283 billion. Much of that increase in value, of course, has come at SABMiller, which has gone from $75 to $100 billion. That's a premium being paid. But AB InBev has also seen an $8 billion increase in market cap. Perhaps a history of AB InBev's acquisition and the fact that 3G Capital, one of the prime drivers of AB InBev, has been known to do good acquisitions, is playing into how the market reacts. It should be noted, though, that if this deal goes through, there are going to be some consequences which are not positive. The first is, it's almost a given that if this deal goes through, SABMiller will be forced to divest itself of its joint venture holding in Miller Coors. Now, who will it have to divest itself to? The other half is owned by Molson, and they get first bids, and odds are that they're going to be the buyer on that particular transaction. There's also the possibility that other beer manufacturing in other parts of the world, like China, the combined company might be required to divest itself because of antitrust requirements. So that's the setup. Let's look at the two companies involved in the deal. If you look at the acquiring company, you can see the numbers. It actually has revenues of about $45.8 billion and a very, very strong operating income of $14.8 billion. Its operating margin is about 32%. It paid an 18% tax rate, earned a return on capital after tax of about 12%, and has been pretty active in reinvestments, a lot of that reinvestment coming from acquisitions. It has about $51.5 billion in debt and $1.5 billion in lease debt. Its market cap was $174 billion. This was pre-bid on September 15th. The debt to equity ratio was about 31%. The debt to capital ratio was 23%. The company has a good rating, an A2 rating. So that's the acquirer. If you look at the target, here's what you see. Its revenues were about $22.1 billion. Its operating income is healthy, for $4.42 billion, but its margin of about 20% is much lower than the AB InBev margin. The effective tax rate is higher, reflecting where SABMiller operates. Its return on capital is not bad, but again, not as good as AB InBev's at 10.32%. It doesn't reinvest very much. It's a much more conservative company when it comes to reinvestment, with a 16% reinvestment rate. It has about $12.5 billion in debt, and its market cap pre-acquisition was about $75 billion. Its debt-to-cap ratio is much lower than ABInBev's, and its rating is slightly lower as well. Now, it should be noted, as I said, that SABMiller has those joint ventures and other associates. We'll have to deal with them when we talk about the valuation of SABMiller. But here's the challenge. The market cap for SABMiller was $75 billion on September 15th, at the time that the original announcement was made that ABInBev might be interested in buying SABMiller. The deal was completed pending regulatory approval on October 13th, when ABInBev agreed to pay $104 billion. You take the difference between those two numbers, you have a $29 billion premium over the market cap. The question we have to address as investors in ABInBev or as observers is whether there's enough value being created in this merger to justify a $29 billion increase in value. At least the market seems to think so, because it added $33 billion to the combined market value of the two companies after the merger. So let's step back and think about why companies do acquisitions. There are three, and only three, reasons that are consistent with intrinsic valuation when you do an acquisition. The first is you buy a target company because it's cheap. In other words, you buy a target company for the same reason you as an investor buy a cheap stock. So here, undervaluation is driving your acquisition. There are relatively few companies that have succeeded in this strategy, but it could be the first reason. The second is control. What's control? You see a company that's badly managed and badly run, and you believe that you can run it better. The value of control comes from the fact that if you run it better, it could be worth more, and the value of control captures that difference. The third is synergy. Synergy, of course, is a word that gets tossed around in mergers, but synergy can take one of three forms. It can be offensive synergy. What do I mean? Not offensive in the sense that you don't like it, but in terms of going for higher growth, higher prices, a bigger price premium. Those you're trying to push up your top line, and through pushing up your top line, increase your value. It could be defensive synergy. This is where I'd put cost cutting, economies of scale. And consolidation, in a sense, is part of a defensive synergy. They still increase your cash flows, but they increase it by reducing your costs. And the third synergy, which is often unstated because you don't want to emphasize it too much because the tax authorities obviously get upset, is tax synergy. If you can take advantage of clauses in the tax law that allow you to get value from the merger, either directly or indirectly by borrowing money. So let's think about the four numbers we have to look at to make sense of this merger. The first is the acquisition price. In the case of ABInBev, it's going to be $104 billion. That's what they're paying to acquire SABMiller. The second is the status quo value of SABMiller. So let's say if in fact SABMiller was so undervalued that maybe that's why they paid the $104 billion. The third is maybe ABInBev sees a potential for changing the way SABMiller is run. That's a restructured value. Maybe that'll push them above $104 billion. Or maybe there is enough synergy here, and that synergy can be valued by taking the value of the combined company with all the benefits thrown in, higher growth, lower costs, and subtracting out the value of the standalone acquiring company and the restructured value of the target company. So if you're looking at an acquisition and asking whether it makes sense, if the motive is only undervaluation, the price of the target company has to be less than the status quo value. If your motive is control, the price you pay for the target company has to be less than the restructured value. If your motive is synergy, the price for the target company has to be less than the restructured value plus the value of synergy. Notice that these motives are not mutually exclusive. You could have all three reasons in the same acquisition. So here's what I'm going to do. I'm going to take SABMiller and first value the company on a status quo basis. In other words, I'm going to put myself back in September 15th and say, as an investor, what value would I attach to SABMiller? Now, if you look at the company's conservative reinvestment policy, here's where it shows up. You reinvest very little. You're not going to grow very fast. In this case, I'm giving SABMiller a growth rate, a fairly anemic growth rate of 1.65%. Incidentally, I'm doing my valuation in US dollars simply because it's convenient for me. The value that I get for the operating assets for SABMiller is $43.7 billion. Now, before you get too depressed, though, remember I told you about the two other holdings that SABMiller had. So I also valued the joint venture, the Miller Coors joint venture, which is an entirely US-based joint venture. I valued their 58% stake at $12.9 billion. And I also valued the other associates where SABMiller has a minority holding, and I valued those stakes at $7.9 billion. Notice my equity risk premiums are different for SABMiller Coors and the associates. With Coors, I used the US equity risk premium. With SABMiller, I used a weighted average of the equity risk premiums in the parts of the world they operate. And here's where the flip side of having that large Africa market share kicks in. It pushes up your growth, but it also comes with higher risk. So that equity risk premium reflects where you do business. The value that I arrive at as a status quo value for SABMiller is $51.5 billion. Of course, I could be horribly wrong on my inputs, but it is what it is. And at least based on the status quo value, as an investor looking at SABMiller, trading at 75 billion, I wouldn't have thought of it as a cheap company. So maybe cheapness was not why ABInBev looked at SABMiller. So here's what I'm going to do. Since it doesn't look like SABMiller is undervalued, I turn my attention to the possibility that maybe it could be run differently, run better, and maybe that's why ABInBev is interested in it. To get a sense of how much potential there was for change, I compared SABMiller's numbers to ABInBev's numbers and to the industry average, the global industry average for alcoholic beverages. So let's take it number by number. Let's start with the margin. SABMiller's margin of close to 20% is lower than the ABInBev margin, but that might reflect the fact that ABInBev gets so much of its revenues in high margin parts of the world. And if you look at the global alcoholic beverage sector, it's 19.23%, actually lower than the SABMiller's numbers. If you look at the effective tax rate, SABMiller does have a slightly higher tax rate than ABInBev or the global average, but that again might reflect the parts of the world it operates in. On the return on invested capital, SABMiller is the lowest of the three, so maybe there's a potential to push it up to the industry average, which is about 17.16%, and the after-tax return on invested capital will reflect that change. And finally, on the reinvestment rate, SABMiller has been a lot less aggressive than either InBev or the alcoholic beverage sector. On the debt-to-cap ratio, it is true InBev is more levered, but the global average is only 18.82%. So here's what I decided to do. I took SABMiller and changed some of the numbers. Here are the numbers I changed. First, I changed the debt ratio from what it is today to the 18.8%, which you saw for the industry. That pushes down my cost of capital. I did also assume that the return on capital and reinvestment rate, the pre-tax return on capital and the reinvestment rate for SABMiller could be pushed up to the industry average. With those changes put in, the value that I get for the company with the changes is $56.2 billion. That's a $4.7 billion value of control. But even if I add the $4.7 billion to the $51.5 billion, I'm still well below, forget the $104 billion, the $75 billion at which the company was trading at before the deal was announced. So at least from my perspective, it's not control that's driving this merger, which technically leaves me with only one other option. It has to be synergy. So I try to make my best guesses of how much the synergy would be worth. And here are the changes I saw as potential changes. I do think that maybe with cost cutting and moving into each other's markets, that the operating margin could be pushed up a little bit for the combined company. Notice that when I consolidate these companies and make a combined company, the margin for the company, if nothing changes, is 28.27%. It's weighted more towards the ABInBev because it's bigger. And I'm assuming that that margin maybe can be pushed to 30%. That might not sound like much, but that's almost $1.7 billion in cost cuts that I'm assuming in synergies. I'm also going to assume that maybe because they're able to exploit each other's biggest markets, ABInBev in Africa and SABMiller in Brazil, that maybe they can push up the return on capital and the reinvestment rate, which in turn pushes up the growth rate from 5 to 6%. Again, that might not sound like much, but when you're already the largest beer manufacturer in the world, a 1% increase is a pretty substantial increase. With those changes put in, I revalued the combined company, and I got a value of $276.6 billion, which is $14.6 billion higher than what I had got originally by adding up the companies. Adding up which companies? ABInBev valued status quo and SABMiller valued restructured. And what I get is my value of synergy of $14.6 billion. Now that's a pretty hefty value for synergy, but if I add that $14.6 billion to my $56.2 billion, which is my restructured value, I get a total value of $71 billion. That's well below the $104 billion that ABInBev is paying for SABMiller. So at this stage, one or two things has to be true. Either I've screwed up incredibly and ABInBev is going to find other ways to make that extra 33 billion. And that's entirely possible. And here's why I say that. ABInBev has a history of doing acquisitions well. And its lead investor, 3G Capital, is known as a steward of capital. So maybe they have a plan in place which will create the additional value. Or maybe Maybe. And even smart people sometimes make mistakes. They've overpaid. I'm not sure which one it is, but as a stockholder in InBev, which is a part of AB InBev, I have a vested stake in this, and I hope they can pull this off. But my hopes are not founded, at least in the numbers as I see them right now. Thank you very much for listening.